learning and development programs designed to foster decent, sustainable work and economic growth. All right, I'm told Sheila is the center coordinator for Mombasa. In Mombasa, they meet at Moi Avenue, opposite Frontenella. I was actually there a couple of weeks ago, but I just don't remember. Thank you so much, Sheila. So the big purpose of what we do at Passion Profit is to support individuals, not just business owners, but we're a learning and development organization. So we support individuals so that they can create decent, sustainable work and economic growth. This morning, we have an exciting lineup for you. We will be having Anne Kimari. She's the founder of Finebridge Associates, and she's also this is the company that we use for all our finance and HR issues. So if you're a member of the association, or if you come to Passion Profit and you have any need around or any support around finances and HR, then the company that will support you is Finebridge Associates. And Anne will be speaking to us about using Profit First methodology to navigate hard financial times. You do know that in the last 2 weeks, we have been talking about the Profit First methodology. And we've been saying that you can make a profit in every sale if you use this methodology. And Anne is a CPA. She's going to be helping us today to understand where can we get started. And I highly encourage you to get an accountant to do an audit of your accounts before you start. And Anne is the best person to do that. You will see her contact as we carry on in this conversation this morning. And if you need to get in touch with her, just get in touch with her and you have her. So as we carry on, just a little housekeeping. Again, on the screen, if you have your mouse, you hover your mouse on the screen, you will see the menu bar. It will either be at the top or at the bottom. I keep mine at the top. And on the very left-hand side of the menu bar is the mute button. We kindly ask you to mute yourself so that there is no echo. We are very conscious that you're working from home and the little ones may be running around or there may be cars passing around your home. And that's all right. We need you to be comfortable. Just put it on mute. And then there's the video. We encourage you to turn on your video so we can see your pretty face. And just remember, we're in a mentorship place, so there's no harm in turning on your video so we can see you and engage with you. When you move to the right, you'll see a question and answer icon. You can click on that icon and put your questions there as the conversation is carrying on. And during the time for question and answers, we will answer your question. And I think all the way to the right, there are 3 little dots that say more. When you click on those 3 little dots, you'll see, it will say chat. You can click on the chat. If you want to speak to me, you say Frida panelist. If you want to speak to everyone, you just go ahead and whatever you're saying you want everyone to see, you go ahead and put it there. Once you put your chat, I will see it and get to it at an appropriate moment when I can catch my breath. So don't worry once you set it that I'm not responding immediately. I'll always find a good time to stop and respond. So what is a conversation? Many people come to these spaces and they think that this is a workshop, or a training. And this is not a workshop and neither is it a training. It is a conversation. And a conversation is a talk, especially an informal one between 2 or more people in which news and ideas are exchanged. So Founders Conversation is an informal talk between founders and a facilitating mentor from Passion Profit or SME Founders Association. And in these forums, we exchange news, we exchange ideas, we exchange experiences, and there's always a facilitating mentor to share the topic of the day. Because this is a webinar, you have a big treat because you get the slides and we have the mentor speak a little longer. So we really wanted to talk about the Profit First and give it more context because there's a lot of panic going on right now. You know, COVID-19, what's gonna happen, this and the other. And the truth of the matter is if you're a business owner, I perceive you have a vision. And if you have a vision, what would you be doing now if COVID was not there? So I find that sometimes we hide behind conditions and circumstances to panic instead of carrying on what we would have been doing. Yes, COVID is around, but you're working from home. What work are you doing? One of the work that you can do is look at your finances and see, are you really on track? Did you make money before COVID got here? How do you plan to make money after COVID goes? What are some things you can do for your clients even while COVID is happening? At Passion Profit, we continue to carry on webinars. We had a webinar on Monday just to give people some encouragement and support during this hard time. And we also had a webinar yesterday on how to use online tools to help people get in touch with the reality that digital is not going away. So if you're still complaining with your devices and still complaining about Google and Zoom, it's time to wake up and smell the coffee. Digital is not going away even after COVID. This is an opportunity for you to get to learn how to use it so that you can be better beyond COVID. And you'll save a lot of money by not hanging around in traffic and waiting for people in meeting rooms or in restaurants, wasting your money drinking tea and samosa. So thank you so much for being here. I see a chat here. Let me see who's here. This is Emmanuel joining us from Utawala. Karibu sana, Emmanuel. And I'm going to just hand it over here to Anne. And I just want to tell you who Anne is. And Anne is a CPA. Anne is okay, now we call them CPA. CPA Anne Kimari is currently the principal Finebridge Associates Limited. She's the principal at Finebridge, and it's a consulting house that provides financial and business advisory services to SMEs and microfinance service providers. She has over 20 years experience in the corporate SME and microfinance sector and began her career in PricewaterhouseCoopers as an external auditor. She does what she does for the love of it, and because that is what she was trained in and has a good grasp of. Anne is a fantastic finance person, all right? And her favorite quote is from the book of Jeremiah, chapter 29 and verse 11. She says, "The Lord orders my steps and knows my plans to give me hope and a good future." So even as we welcome her on board, I believe that the goodness of the Lord that she carries is going to be upon us. I see a chat here, and Anne, get ready because I'm going to hand over to you. Lillian, thank you very much. Lillian says she's joining us from Dagoretti. So I'm going to allow Anne to continue in the next for us in the next session. Anne, you're welcome. Thank you so much for being here today, and thank you so much for everything you do for the SMEs at Passion Profit. Karibu sana.
Asante. Thank you very much, Frida, for that introduction. I first of all want to sincerely apologize. I have not been defiant of Frida's request to put on my video. Just this morning, we had a challenge trying to get the video working. And so we decided that it's better to hear me than to see me. I would have loved you to see me put on makeup, being at home. So unfortunately, you will not be able to see me at this moment, but maybe in a future forum we will be able to meet. So sincerely apologize. I have not done it intentionally. Would have liked you to have a look at me. So great. So we get on to the topic of today, and we have partnered with Frida for some time now. And like she said, I am a trained accountant. I was introduced to the profit methodology through Frida, which is a very interesting, profit first methodology is a very interesting method that seems to look like it's defying my training in accounting. But I'm excited because it's a very practical way and simple way of running your business, especially when you're starting up and especially when you're still small and wanting to grow. So let's start with the quote that I have there. And Maya Angelou is one of my favorites. She was a top civil rights activist and embraced a spirit of positive thinking and sheer determination. So if we look at what she says, we may encounter many defeats, but we must not be defeated. So even in this journey of entrepreneurship, there are many challenges that you go through. No entrepreneur doesn't go through challenges. We all go through them. But I believe with a positive attitude and with a resilient spirit, we can we can overcome. So Frida, the next slide.
Okay.
Yeah. So why profit first? Like I mentioned, profit first methodology, for those who don't know it, I believe you may want to join Frida in her other talks, but it has a very interesting way of how changing the way we think about doing business. It actually premises on taking your profit first and then paying yourself as an owner, paying your taxes, and whatever is left after that, let that be your operating expenses. We many times use the other way around, where the operating expenses swallow us, such that you don't have anything to pay yourself or to pay your taxes or even to earn a profit. So we will look at 4 principles from dietary science to try and illustrate this profit first methodology. And then we'll look at how to set up 5 accounts or 5 envelopes, and how to make it work. And then we'll recap and take some questions and answers. So we can move ahead. So like I mentioned, profit first is built on this simple idea. Before you pay your expenses, take your profit first. Run your business based on what you can afford now, not what you hope you can afford someday. Obviously, that is a mind shift. If you apply the profit first to a new business, you could start making profits from day one. And if you've been losing money for many years, can't even pay yourself a salary, then it's time to transform your business and overcome the hard financial times that you would be facing if you don't use this. This is a method that has been developed by Michael Michalowicz. Initially developed this methodology to address his own financial woes. As an entrepreneur, he went through the same thing. He was able to debunk 2
And are you there?
apologies, one of which Michael was debunking is when he says bigger is better. It's not, I think we can go back a little. Yes, bigger is not necessarily better. If anything, it actually pays to remain small until your business demands you to grow. The other thing is where you equate sales to cash. Like when you get your income, you immediately think that, oh, you have the money to do what you need to do. But it doesn't necessarily mean that, because when you get any sale, you need to know that that sale caters for profit, it caters for your expenses, it caters for your taxes, and it will cater for your operating expenses. Okay, next slide. So what is this? What are the 4 principles? 1, when you're dieting, you're asked to use small plates. You can reduce your food intake when you do that. Secondly, you consume nutritious food first before high-calorie ones, so that you get the nutrition you need and you minimize on high-calorie. Thirdly, you remove temptations, keep the profit away first, because you're very likely to start going into your operating expenses before you have taken your profit. And then lastly, building a rhythm. So what does that all mean? When we say use small plates, when you have one bank account that you put everything into, it gives you a false sense that you do have a lot of money in your bank, and you feel obliged to make payments that you really did not want to pay. So what we're trying to do is to ask you divide that account into many accounts and see how little each has. Nextly, consume nutritious food. We're talking about being able to prioritize and pay what needs to be paid first and leave out those that don't need to be paid to last. When we say remove temptations, keep aside your taxes, keep aside what you take as your profit, put them aside in an account that you will not touch, or it will be hard to take. And build a rhythm means repeat this practice. When you repeat something, it becomes a habit. So we can move on.
Okay.
So let's get started. How do we do this? Move on. In our next slide. So we have an example of a company A that made $110, or let's call it shillings. And even as it earned that, it made a loss in operations. And so it makes you feel bad that you are able to have this money come into your account, but you did make a loss. You would need to know what formula to work to allocate your profits so that you're able to take on the profit first, pay yourself, pay your taxes, and leave your balance as operating expenses. Does that sound weird? Well, as I said, it takes a mind shift to do this. You need to go back to basics. When you had envelopes, when you started off, you received a salary. For some of you, maybe not all of you did this. And because you wanted to pay your rent, you kept your rent aside. And you wanted to keep your bus fare, so you put your bus fare aside. And you wanted to make sure that you have food to eat. You put your food money aside. So it follows the same principle. So let's go on and see how this works. So the 5 accounts are like the 5 envelopes. You have an income account, you have a profit account, you have an owner's pay account, you have taxes account, and then you have your operating expenses as what's left over. So how does it work again? Obviously, you have to have some formula to use this, but it means you literally set up 5 actual accounts, which you call income, profit, owner's pay, tax, and operating expense, or OPEX. Can you see the glasses on the side? That's how you'll distribute a check that you have received. You would distribute it to your income, to your profit, to your owner's pay, your own pay, your tax, and lastly to your expenses. What does that mean? Very likely your expenses will be squeezed, but you need to have wisdom so that again, you don't have zero, because you need expenses to build up your income. So we're asking that you would have current accounts with checkbooks, and this will help you so that you're able to make the allocations differently and be able to have your expenses paid from the operating expense account that you will have. All your revenue are deposited into a new account, which really is your revenue account. Okay, next, please. You can go next. Now, the 2 no temptation accounts, if you have the will to do it, you can just hold them in the same account, or otherwise open a separate bank account. This would be the profit hold and the tax hold. This, you would rather put them in savings account so that you're not able to easily move them. You can earn an interest on them. And when it comes to time for paying your taxes, you have money to pay your taxes. You don't get in trouble with the authorities. You need to disable any convenience options such as online banking or checkbooks so that you are careful not to touch these funds. They need to be out of sight and out of mind. So next. Great. And we have our partner, SBM Bank. Why not use them? This would be a fantastic bank for you to open your functional accounts. They provide easy access to view your accounts and transfer. And for the no temptation bank or no temptation accounts, make sure that they are savings accounts which do not have the convenience that you have with the other with the other accounts. Okay, it means that these are the kind of accounts where you actually need to physically go down to the bank and make the transaction over the counter. Now, that's not very easy to do when, especially in this lockdown time. So let's move on. Back to our company A, and we're assuming that you made a figure of 110 for the year. Of course, this is just as an example. The figures may be much different. And assuming that you have a bit of experience of how this company has been doing for at least a full financial year, and with any sale, there's those direct costs that go into making the sale. It could be the cost of purchase for the items that you're selling, or it could be the actual cost of doing the item, making it, if it is something that's being made, and assume that cost is 40,000 shilling. So what's your real revenue? The real revenue, not the gross profit, because we are not talking about gross profit here. We are not looking at salaries. The real revenue would be your sale less the direct costs, less salary. You're not going to consider salary at this point, any salary costs. So that will be 110 minus 40,000. Okay. We have assumed that the owner took from the business about 50,000 during this period. And we assume that the owner was able to have expenses of tax and operating expenses of 6,000 and 48,000. Well, if you do the math, there was no profit. If anything, there was a loss. So what's the first thing we need to do first? We need to define what your allocation percentage would be using the profit first model. So I have a table next that illustrates this. But before we get to the table, let me define the allocation percentage, which is TAP. These are healthy numbers that we should work towards. They have been put together by Michael Michalowicz based on his experience working with thousands of healthy companies in the United States. You can use these numbers to start implementing the profit first and then return later to refine them once you have a better grasp of the system. They definitely would vary from industry to industry or sector to sector depending on the age of the company. So you'll find that the percentage allocations for a company in its first year of business would be different from one which makes much more revenue. Ideally, the first year of business, your sales may not be as high as in subsequent years. So your goal is to move from your current allocation, which we had given an example that showed no profit, to target allocation percentage. Now let's illustrate that on the table. So here is a table, and for company A, we have the actuals, which shows the sales, the direct expense, and the real revenue. So it's the sale minus the direct expense that gives us the real revenue. And that's where you start allocating from. So for this company, they had made no profit. If anything, they had a loss of 34,000. Okay. And if we were to allocate our profit first and using the TAP allocation, this entrepreneur would have taken 5% of 70,000, which is 3,500 as his profit first. And then again, using the allocation percentage, you would take your owner's pay at 40%. In this particular case, this company had taken quite a bit. at 40%, but there was no formula in the current in the last year. But if you apply the 40%, that owner's pay should have been no more than 28,000, which is 40% of 70,000. Now, tax, we have taken 16%. We are assuming that there is VAT, but we also know that there is the income tax at the end of the year. But for purposes of this computation and for this example, we have taken 16%, which you put aside from the sales, and that comes to 11,200, which is the 16% of the real revenue. What's left is 39%, which is the operating expense, and that comes to 27,300, 39% of the 70,000. What does this mean? It means that if we go to, go back, yes, still on the same table, on the fourth, or rather the fifth column, calculated numbers from the real current allocation percentages, the owner needed to increase what he gets from his profit so that he gets at least a profit from every sale that he makes. So that means you need to allocate first your profit of 3,500. It also means that you need to reduce what you take away from the business. Instead of taking away 50,000, you just need to take 28,000. At least you have something you've made and you have retained something that will cater for the other items. And it means that you also need to increase the amount you put away for your taxes so that you have enough to pay your taxes and the authorities. And lastly, whatever remains, you need to reduce your operating expenses. I know this is a difficult one, but it requires gradual discipline to try and reduce these operating expenses. So let's see how we can reduce that. We can go to the next slide. If you're not able to increase your revenue, it's much easier to manipulate the expenses. So to increase your profit, we've talked about how you allocate the 5%. We've talked about how you need to reduce the owner's drawings, and so that you create a buffer that helps you allocate a tax expense and put it in a no temptation account, an account where you will not have easy access to. And then lastly, reduce your operating expenses. And I say that that usually is not the easiest thing to do. So what do we propose? Next slide. On the next slide. So you need to list down all your expenses for the last 12 months, your recurring expenses and your one-off expenses. And you need to decide for yourself what is necessary, what is not necessary. Typically, you'll find that you probably have a big office space that you don't need. You probably will need to, well, we can go back first. Let's go back a little. Frida, yes.
There, okay.
Yes, there we are. So you may want to see, do you have membership fees that you pay for? Do you need to reduce those? Do you need to cut it off? Do you need to move to a smaller space? The only thing we would say is consider your staff very critically. Don't cut on staff salary, but you may want to consider who do you need to have and who do you not need to have. So using this methodology, we deposit your revenue into the income account whenever you receive it. And then on the 10th, this is a proposal. On the 10th and the 25th, you now do the allocations. So you distribute your income balance, that real income, based on the allocation percentages, the TAPs, and transfer the amounts into the tax and profit accounts on the 2 dates. And then take your allocated bi-weekly salary from the owner's pay account. Once you put it in, and then when you need it, you'll be able to take it when you need it. Now, sometimes you may have debt and you're trying to survive from high debt. And the next slide. Yes. Now, if you're heavily indebted with no cash reserves, you'll intuitively want to focus on repaying your debt. However, this only addresses your symptoms and not the root cause. The only way is to try and remove that debt permanently. What does it mean? It means changing your financial habits to try and become truly profitable. So try by doing a debt freeze. Don't take any more new debt while you try and cut the cost and remove your existing debt. You need to speak to your creditors to give you time to do this. And you need to be very disciplined so that you can cut off and not incur more debt. And then look through your expenses and see what are your 3 categories of expenses. I don't know whether you can see the third one. Great. So there are those expenses that are essential for your profitability. Of course, there are those items that you cannot cut off, otherwise the business closes. So keep those with a P, mark them with a P. And then there are those that are essential, but they can be replaced with cheaper options. So start seeing what are those that you can replace and mark those with an R. And then thirdly, mark the ones that are unnecessary, totally unnecessary for you, or they have been good to have, but you can actually cut them off. So mark them with a U. Systematically, you'll be able to see what you can cut off, what you can replace, and what you will actually need to keep your business running. So next slide. So let's recap. We've talked about having a mind shift so that you can become profitable from the word go. And if you have been having hard times, this probably would be a way in which you could survive the hard times and even come out stronger. So what are we saying? We're saying you create 5 physical bank accounts and label them income, profit, owner's pay, taxes, and operating expenses. As we have seen, the operating expenses really is the leftover. Traditionally, the profit has been the leftover, but in this case, we have taken the profit out first. So that means the operating expenses are squeezed. So it means also having a mind shift on how you're going to tackle your operating expenses. Figure out the top allocations, and Michael Markowitz of Profit First methodology has some suggestions. If you do liaise with Frida, she will be able to guide you on that. It is based on experience, of course, in a foreign country, but these are adaptable for our Kenyan environment. And align it gradually to the top allocations over time. We know it's not a one-stop thing. You'd have to do it over a period of time. If you're in debt, we're talking about freezing your debt and reviewing your expenses. Categorize them into the 3 options so that you know how to deal with each expense categorically. Stick to the plan expeditiously. Create a rhythm. And lastly, call upon us, PassionProfit, or ourselves at Finebridge, and let us help you set this up. So thank you very much for giving me time and listening to me, and I do pray for your success. Thank you. If there are any questions, perhaps we can have some time for questions and answers.
Wow. I wish we could clap for Anne. You can just clap for her wherever you are. And thank you so much for that wonderful presentation. I love the way she does it because she's an accountant. She puts a lot of context into it and shows you that indeed it is possible. So at this point, we're going to open it up for questions. And just like she has explained, this is very possible even here in Kenya. And at PassionProfit, we use Finebridge Associates for all our accounting needs, and all the SMEs who come to us, we recommend Finebridge Associates. Remember, she's from PricewaterhouseCoopers, so she has set up her own PricewaterhouseCoopers, so to speak. So they conduct, they do accounts, they do HR, and they're really the company that if a company needs a business plan, it's Finebridge Associates that does the work for us. So as PassionProfit, we believe in collaborations. So we're not trying to be everything to everyone. We have partners to provide all the services that you need. And for your accounting purposes, it is Finebridge. And for the Profit First methodology, and will help you set your house in order so that you can start getting a profit. So I see the questions there. You can put your question in the chat or in the little icon written Q&A. It's the fourth icon from the left. And let's see what you have to say here. Thank you so much. I see some claps. Please send your claps in the chat box. Thank you. And big hand clap from Mercy Kimari. Thank you.
Thank you.
And thank you for the easy and understandable sharing, says Sheila from Mombasa. Maureen says hand clap. Sheila, hand claps. Thank you so much, people. I see some hands raised. At this point, if you have something you want to share with us, I welcome you to put it in the chat section. If you want, okay, I see that question. If you want to speak, I'm assuming if you're raising your hand, do you want to speak? I think so. So I'm going to allow you to talk here. Allow you to talk. All right. And I see some hands raised. The first hand I saw raised was Hudson. Hudson, you're free to talk. And after that will be Kamal, followed by Sally. Hudson, you're welcome.
Thank you. Thank you, Frida. I must say I raised my hand by mistake.
Okay.
But, now that
the excitement, maybe you are going to clap for Anne.
Now that I have the mic,
yes, sir.
Let me thank Anne for a good presentation.
Yes.
And I'm wondering how many people are on, and therefore asking whether is the talk too early? Thank you.
Thank you for that question, Hudson. What time do you think will be a better time for the talk? We normally have the physical meetings at 8:30 to 10 at a physical location at SBM Bank. And now we assume that because people are working from home, they will be at their desk, but not to worry too much because there's going to be a recording of this, and the recording will go to everyone who has registered. One thing about online learning is that the big thing you need is discipline. And then the next thing is you can collect all the things that you want to learn and have a time scheduled for learning. For instance, I always collect the interesting forwards that I like, and I watch them on Sunday afternoon. I don't try to disrupt my day as I'm going. So as the world is changing and we're working from home, one of the key things is not to essentially be at the webinar. It's good to be there if you can, but you always want to register and get the recording and make sure you have a time for study, a time for reflection so that it gets done. Thank you for that question. The other hand I see up is Kamal. Kamal, did you have a question or a contribution, or was that a mistake? All right, the hand has gone. No, her hand is still up. Kamal, did you want to share something? Okay, maybe it was a mistake. So I'm going to go right into the questions. And the questions, Wanchiko Wambugu says, is there a benchmark? There are benchmarks, Wanchiko, and if you go into online and look for Profit First professionals, there will be lots of benchmarks. I don't know if you'll see any Kenyan ones. I believe we are the first company to work with this tool to help SMEs. So and we know the guy who's written the book. He has done one of our webinars. If you have any questions or need help for us to contact him for you, we can always do that. Thank you for the question. I see Elizabeth Nyambura, and that's Wanjiko Wambugu, I believe, from Mombasa. Thank you for signing in. And Elizabeth Nyambura is saying, for startups, how would one set up the tap allocation and the profit first methodology? And that would be a question for you.
Yes, thank you. I think if the book by Michael, he actually has a suggested table that shows from 0 to a certain amount of income. And the allocation that I used in my presentation works on that particular one, where you have incomes that are below, I believe he says $250,000 in that is in dollars. So if you equate it in Kenya shillings, that would be about 25 million. However, remember that this is done by somebody based in the West. So we'd have to sort of work out a Kenyan formula. But that is just a rough guide. It is just a way to give you a suggestion of how to do it. When it says 5% profit, it tells you whatever sale you do, make sure that you have some profit in it. So take out the 5% profit as your money that is earned from that particular job. What we're trying to say is don't let the operating expenses choke out your profits. You need to work on your operating expenses to reduce those so that you're able to have enough to pay for tax, enough to give you a profit and give you an owner's pay. So these are just benchmarks that would be available on that particular book. But eventually it would be how you choose to allocate for yourself, and how you choose to price your product so that you make sure you've catered for your taxes, you've catered for your profits, and for your own pay on it. I hope I've helped in answering.
Thank you so much, Anne. And I think it's very important what Anne is saying, that before we dive into the profit first methodology, we need to look at our cash flow. How are we handling the money that we're already getting, and how are we spending it? And then we apply the methodology. And I always encourage entrepreneurs, do not try to do stuff that other people can do for you. Focus on your core and get the expert to help you. And that's why we have Finebridge Associates. I've read the book. I'm working towards being a profit first professional, but we still have an accountant. So this does not replace an accountant, because you do need an accountant to ensure that you're costing right, you have a budget, and that you're managing your cash flow. So thank you for that question. And I see a few other comments here. Maureen says, I wish I had known of Profit First 3 years ago. But as the Chinese proverb goes, the best time to plant a tree was 20 years ago. The second best time is now. This is definitely one of my aha moments as an entrepreneur. Thanks, Anne, for a great conversation, for a great presentation. And Kamal Deep Sandhu says, if you make a loss, how can you allocate money? And hold that question, Anne, as I look at another one here. So Kamal wants to know how you can allocate the money if you're making a loss. And Rispa Bet says, I'm happy and grateful to be here virtually today. We are also happy that you're here, Rispa. It's my first time, and sincerely, I have learned a lot. And thanks for that beautiful presentation. Rispa watching from Pangani, Nairobi. You're very welcome, Rispa. And when Jiko Wambugu says, when you take the profits, remember to save for a rainy day like today. Thank you very much. And Jiko Wambugu runs Nyali Capital in Mombasa and EcoBiz Sacco. Thank you for that warning. And Audrey Kiroche says, how do you ensure profit in a consultancy business that bills by the hour? Is there a percentage? So that is another question for you, Anne. Audrey would like to know how do you ensure profit in a consultancy that bills by hour, and is there a percentage? And then I'm going to add you one more question there from Susan. Susan says, according to this formula, is 30% income tax paid from the 5% profit? Currently, it's only taking account of VAT. And yes, she did only talk about the VAT, but I'm going to allow her to answer that question. So Anne, you're ready? You have 3 questions on your plate. You can take it away.
Okay, you'll help me out with the questions. The first question is...
I can ask it to you again. The first question is, if you make a loss, how can you allocate money? By Kamal Deep.
Okay, remember, this method talks about taking your profit first. It talks about reorganizing your mind so that you're able to take a 5% from the sales that you've made, the income that you make, and then take out your earning. You can reduce your earning. It doesn't have to be the 40% that profit first. You see, these are suggestions. You don't have to take them 100% as they come. It's up to you, really. Decide that you're going to take on, even if it's 20% as your owner's pay, but also make sure that you take on out the taxes. Now, if you notice, I have put 16%. And while I put 16%, yes, that is the percentage that we use for VAT. But remember, you also have input tax that reduces on VAT. So when I said 16%, I was trying to cater for all types of profit. In a first year of a business, okay, remember that this is a way of managing your cash flow, and it may actually on paper look different when you use as an accountant, I'll call it the International Financial Reporting Standards. It may look different, but when you're managing your cash flow, it could be different, right? So it may look like 16% is VAT, but I'm trying to see if we can cater for profits within that. So I hope I answer that. You're taking out your profit first so that you don't make a loss at the end. Second question, Frida.
Second question was the someone from consultancy, and that is going to be our last question. All the questions will be sent to Anne, and then we're going to share them with the video on your email. But I had talked about how do you ensure profit in a consultancy that bills by the hour? That is the last question we're